This conference will now be recorded.
Hi, my name is Bruce Dweck with Keller Williams Realty, and I'm here today to share with you information on the best way to get pre-qualified for a loan. And today I have with me Shay Peck with Bank of England Mortgage, who is an expert in this area, has been in the business for many years, and we can talk to you about getting pre-qualified. The two things that are critical in getting pre-qualified are debt-to-income ratio and credit score. We're going to cover the first one today. Shay, why don't you tell us what's important about this and what we need to know?
Absolutely. So your debt to income ratio is one of the important factors on whether you're qualified for a certain amount or for a loan. So when we look at that, we're looking at your gross monthly income. So we are looking at it prior to the taxes and everything like that, gross monthly income and your monthly debt. So we'll say if you have $10,000 student loan, but you pay $100 on it a month, we're counting that $100 factored against you with your monthly income versus the total amount of debt. So we're comparing the monthly debts versus the monthly incomes together. So that's really what's defining the debt to income ratio. Why it's important is because we want to make sure that you're not overextending yourself as far as your home payment compared to everything else that you've got to pay as well. Some things to keep in mind that we actually don't factor into it are things such as your phone bill, cable, electric. There are a lot of things that we don't look at if it's not on the actual credit report, such as your car payment or a student loan or a credit card. We're not factoring that in. So I do always remind my borrowers, especially first-time home buyers that haven't had such a payment with all the utilities and everything combined, you've really got to be careful because you'll have all those things to pay for too each month. So what's most important in the debt to income factor is there are different caps per each program. However, as long as we like to stay in the 30s would be a good range to be in. That's a normal range for people. Between the 20s to 30s, that's a safe place to be. When you get up into the 40% of debt to income ratio, things start to get a little more tight and you got to worry a little bit more when you creep up to that 50 mark if, you're able to even go forward.
Right. So it's important that people realize that they manage their own debts coming into buying a home because you as a lender, you're going to look at that critically in order to lend them the money to buy the house.
Absolutely. And then they've got to remember all the other little debts that we aren't taking into account that they have to make sure that they're comfortable with paying too.
Right. And I've also heard that it's also a good idea not to, make a major purchase when you're getting ready to buy a house because this will adversely affect your debt to income or even your credit score as well. Is that correct?
Correct. So anytime you have someone pull a credit report on you, if it's a hard hit, that bureau will report, so we will see it. In addition to that, people that do that right before they're being pre-qualified for a house or during the process, if we don't see it on your initial credit report and you don't disclose that debt to us, and then we do a soft pull 10 days before closing, and boom, all of a sudden you have a car payment that didn't exist before. We were qualifying you based off of the debts we saw on the credit report. And if we don't know that debt exists, then that's why we try to avoid doing anything around the same time as the pre-qualification.
That makes a lot of sense. Now you mentioned soft pull and hard pull. What are the differences on those things between the two?
A hard pull actually goes and hits your credit. It shows as an inquiry on your credit report that typically stays for 120 days. A soft pull is more or less just an update to see when we do a soft pull right before closing, we just make sure that, someone hasn't added thousands more onto their revolving credit card or that they haven't gone out and purchased a new car or something like that. But we can also soft pull scores just to see if those scores have changed, and if they have increased or something that would be beneficial to the loan, then we can always hard pull on that and use that credit report moving forward.
Okay, great. Well, thank you very much for that. It was very informative. I would just encourage anybody who has additional questions to get in touch with Shay. And if you're ready to start shopping, you can get in touch with me. You can use my mobile search app, and that information will be on our final slide. So thank you very much today.
Thank you.
This conference will now be recorded.
Hi, I'm Bruce Dweck with Keller Williams Realty, and I want to welcome you here today to talk about credit scores and getting started with your home purchase. A lot of people come to me shopping for a home, and they're not fully prepared yet because they haven't gotten pre-qualified. And today I've got Shay Peck with Bank of England Mortgage to help us understand the importance of credit scores and importance of getting pre-qualified when starting your home shopping process. If you do these kind of things ahead of time, you really can avoid a lot of the pitfalls down the road. So Shay, tell us, what's important to know about credit scores and getting pre-qualified so that people can go home shopping and feel comfortable they'll be shopping for a home that works for them financially.
Sure. So with the credit scores, the main thing we want to see on a loan is the borrower's ability to repay. So when you look at a credit report or credit scores, it shows the trade lines of different things that borrowers taken loans out on and how they've repaid it. If there are any late payments or anything like that, it's reflected on the credit report. That also affects the credit scores. How many trade lines you've had in your lifetime also affects your credit scores. Closing revolving accounts out can negatively affect your credit scores because the credit bureaus want to see the longest history, that they can with a credit history. So by closing an account, say it was opened in 2005, and you close it out in 2020, that card and the history from all that time, once it's closed, is no longer existent on your credit. So we tell people a lot of the time you can close, go ahead and pay off the card and cut it up, but you don't necessarily need to close the account depending on how many trade lines or how many cards you have revolving. It can be hurtful sometimes to do that. So we do pull 3 different scores, and that's Experian, Equifax, and TransUnion. Once we pull the 3 scores, we qualify a borrower based off the middle score. If there are 2 borrowers on a loan, we qualify based off of the lower middle score of the 2 borrowers. So we see all of those scores come through. Once we do that, we also get a potential increase that shows us how much potential each borrower has to raise their credit score and by how many points. So if we're in a situation, that we need to increase it, we can easily take a look at things and see if it's as much. Like I have one right now that's paying $76 down on one credit card, and it's going to pop their score up to where we need it. So it's very accurate, as long as you do it in a timely manner.
Yeah. Are there some minimum thresholds for credit scores that borrowers need to be aware of?
There are. At the time of recording this right now, we're in the middle of COVID-19, so there have been some credit score overlays in the industry. So as of right now, our conventional loan credit score for a conventional product is 640. For VA and FHA, we're looking at 660 on those 2. But if we're going through Florida Housing, which is the first-time homebuyer program, VA and conventional are down to 640 with them. So those are the credit score floors as of now. Typically, Florida Housing is always 640, but, sometimes we see lower government credit scores outside of, these are just odd times.
So those are good kind of minimum thresholds that people need to make sure that they reach and exceed as much as possible in order to get a rate on their mortgage. Is that right?
Yes, we consider pretty much anything over 740 prime credit, but any increase that you can get above that 640 or 660 mark, depending on the loan product, obviously helps you. The higher you get, the better it looks for us.
Okay, well, great. That's good information. Thank you very much. I encourage anybody that's watching to reach out to Shay or myself with their questions about borrowing or getting started on a home search. We're here as a resource for you guys. We want you to be successful with home search. We encourage you to give us your questions. And we want to help you avoid any pitfalls in your search. We don't want you to have to start over and so forth. And that's the reason we're doing these videos, is so that you understand what you need to do so that you don't have to repeat any steps in the process. And hopefully this has been helpful to you. And give us your feedback. We'd love to hear your questions. Thank you very much.
This conference will now be recorded.
Hi, my name is Bruce Dweck with Keller Williams Realty, and welcome to our discussion today about pre-qualification and the importance of, and how to, and how it's done, and why it's important. And pre-qualification is one thing that's really critical for me as a realtor, because if you're not pre-qualified, you're going to end up wasting a lot of time, because when your offer is presented to a buyer or to a seller, excuse me, they're not going to accept it because you're not having a pre-qualification letter. Also, it's going to slow down your effort in the process because you have to go back and get that done. So pre-qualification, from my point, is critical because it wastes your time and my time, and it may cause you to miss an opportunity, especially in this market today where homes are so scarce because market and there's short inventory. Pre-qualification is critical. So here to talk to you today is Shay Peck from Bank of England Mortgage to tell you what is pre-qualification, how do you get it done, how long does it take, and just to cover all those things about pre-qualification. Shay?
Thank you, Bruce. So pre-qualification, very, very important for many reasons. First and foremost, you want to be able to know that you are able to afford the home you're going to buy. So I always tell people, I can always tell you what my numbers say you can afford, but you have to be able to sleep at night. So when I start doing the pre-qualification process, I always start with the monthly payment. What monthly payment does the borrower not want to exceed? And that's all things included: principal, interest, taxes, insurance, everything like that. Once I have that number, I can sort of back into a purchase price in which that we can go ahead and pre-qualify them for, so that they have an idea of what amount of house they're looking at per the payment that they're interested in. Obviously, we want to make sure we're putting people in a comfortable position in order to live their life and not have to be able to struggle to buy gas or groceries. And even more importantly, we want to make sure that when you're going to see these homes, you're not looking at homes that are outside of your price range or things you might fall in love with. And then, you know, once you see the monthly payment on that, and you get sick to your stomach if it's too much, you know, if the house is nice and you love it, but you fall in love with it, but the monthly payment's too high, you know, we should have kept you in a better range. So that's really why we want to make sure we know up front how much house you should be looking at. And that way, you know, the realtors are spending their time showing you homes that, you know, they want to see that you're able to afford. So if Bruce takes you out to a house, he knows you're pre-qualified to buy it, and that it's in the range of comfortable monthly payment that you want to be able to pay every month.
Great. So really,
you know, when you're putting in an offer, you want to, the listing and the seller and the listing agent are going to want to see that you're pre-qualified and able to purchase up front. That's always, you know, something, I'm sure, Bruce, don't you think, when you submit an offer, it's obviously much stronger to provide the pre-qualification letter at that time so that they know your buyer's
absolutely.
power.
It makes the offer stronger. It makes the offer stronger if you're ready to submit it with your offer. If you're having to wait and go back and get it, then your offer becomes weak, and then other people with other offers will tend to move ahead of you. So it's really good to have, really is your ducks in a row, to have that pre-qualification letter ready when you start your shopping process. So that helps you, it helps me as the realtor, it helps the lender, and it helps the seller. So everyone benefits by having that pre-qualification letter, and it makes the process run that much smoother. So yes, absolutely. So if you have questions about pre-qualification letters or about financing or about shopping for a home, feel free to reach out to Shay or myself. We're happy to help you. Send us your questions. Let us know if you like our video. If you want to see different topics, let us know. We're happy to do that. Our goal here is to help you become an informed buyer so that you can be successful shopping for a home. And at the same time, when that happens, we're all successful and we all succeed and everyone's goals get met. So thank you very much for watching. We look forward to hearing from you in the future.